Hello, and welcome to this question from AQA A-Level Accounting, June 2020, Paper 1, Section C, Question 17. It's on accounting policies and ethics. Jean is the finance director at GAA plc. As an incentive towards achieving profit growth, the directors receive a bonus. The directors set a target of achieving a 7% increase in profits, and most directors have large shareholdings. Upon reviewing the draft profit figure for the first half of the year, Jean has noticed an increase in profitability of 4%. Herbert, the Chief Operating Officer at GAA plc, has told Jean to ensure the accounts showed a 7% increase in profits at the end of the year. Herbert has suggested the following changes to the accounts. Number 1, change the depreciation method used on all fixtures and fittings from 20% straight line method to 20% reduced and balanced method. The original cost of the fixtures and fittings was £1,200,000, with the balance on the provisional depreciation of fixed fittings being £480,000. 2, ignore adjusting for all accrued expenses which have not yet been paid. This includes a substantial amount of staff wages totaling £44,000. And 3, sell 2 buildings. They have already received an offer of £850,000 for the buildings, which is higher than they expected them to be worth. The current net book value of the buildings is £800,000. Jean has a long-established relationship with the auditors of GAA plc, and one of the auditors of the company is a close friend of Jean. He is sure that the auditors could allow some adjustment to the accounts in order to achieve the levels of profitability required. However, Jean is aware of the principles of ethical behaviour in accounting and how it impacts on his role as the accountant. Required, and this is what we've got to do. Evaluate whether Jean should make the suggested change to the accounts, and your answer should include the associated ethical implications. So, a quick review of the question. Directors receive a bonus if profits grow by 7%. Most directors have large shareholdings. Draft accounts show a profit increase of 4%, and the Chief Operating Officer has told the finance director to ensure a 7% increase in profits at the end of the year. Now, here are suggested changes to the accounts. All of these can be included in your answer. 1, change the depreciation policy. This does not comply with the accounting policy of consistency. Only if there is an adequate reason for the change in depreciation policy, it is acceptable to change it. How would this affect the profit? Current depreciation charge using the straight line method, which is the cost times percentage, would be £1,200,000 times 20%, which gives us £240,000 depreciation charge. The revised depreciation charge using the reduced balance method, which is cost take away accumulated depreciation times percentages, would give us £1,020,000, take away £480,000 times 20%, which gives us £720,000 times 20%, giving us a depreciation charge of £144,000. Change in depreciation would lead to an increase in profit of £96,000, the difference between the £240,000 and the £144,000. This would lead to an increase in profits in each subsequent year, and non-current assets may then be overstated. When the non-current assets are sold, there could be a large loss on disposal, which would dramatically reduce the profit in that year. 2, ignoring the accrual for staff wages of £44,000. This would lead to an increase in the profit for the year of £44,000. The amount would then be included in the following year and reduce that year's profits by £44,000. This is not in line with the accruals concept, where income should be matched with expenses. If the accruals concept is not followed, the auditors are not able to certify the accounts. This could cause problems between the auditors and the directors of the company. Right, number 3, sale of 2 buildings. This would show a profit of £50,000. If the buildings are needed by the business, selling them could affect how the business is operated. The business may then need to lease back the premises, which could cost them more in the long run. If the buildings are no longer used, it could also reduce maintenance costs in the future. This is a legitimate action, and the auditors will not have any concerns about it. The disposal proceeds could be used to pay off any debts that the business may have. The total impact of the 3 changes would be an increase in profits of £190,000, and they come from the following. Change in depreciation policy, £96,000, ignoring accrual staff wages, £44,000, and sell 2 buildings, £50,000, giving us a total of £190,000. It is the director's responsibility to prepare the company's accounts which show a true and fair view and to act in the best interest of the shareholders. Change 1. Change in depreciation policy will affect the comparability of the financial statements. Change 2. Ignoring accrual of staff wages is not allowable. And change 3. The sale of 2 buildings is allowable. If Jean makes the changes, he would not be complying with the fundamental ethical principles of integrity, objectivity, and professional behaviour. Jean has a long-established relationship with the auditors, and one of the auditors is a close friend of Jean. A close friend of Jean, who works for the auditors, should not be involved in the audit of the company due to familiarity with the client. If the auditors were to go along with the changes, they would also be in breach of the fundamental ethical principles of integrity, being honest, objectivity, not being biased, and professional behaviour, acting in a professional manner. In addition, they would also be in breach of professional competence and due care, having the knowledge to perform the work, as there would be certified accounts that have not been prepared in accordance with accounting standards and regulations. Are there any limitations? The company may have been involved in changing the accounts in the past, making them less accurate. The more the company does this, the greater risk of the company being caught. Shareholders will not be happy if the accounts are audited and the manipulations are not being pointed out and disallowed where appropriate. When the shareholders become aware of the manipulations, they may remove the director of the company and take action against the auditors. This would affect the running of the business, the running of the company, and new directors would need to be found. The share price of the company would fall following the revealing of the manipulation of the accounts, and it is not known if the buildings are required by the company or if they are no longer used. Evaluation. Jean should not make the suggested change to the accounts to satisfy the requirements of the directors. It is not fair to other shareholders who could then make decisions based on incorrect data. The draft form of the company is not known, and therefore it is not known if the change will result in an increase in profits of 7%. It is not known what issues would be created for Jean and directors if the changes were made. And there you have a selection of items that you can put into your answer. I hope you enjoyed this video and found it useful. Thanks very much for watching, and I'll speak to you later. Take care then. Bye-bye.